Managed risk, why is that important?
Managing risk is absolutely key. We call it risk optimization, but it's basically putting together stocks that when in combination together, they actually produce a lower volatile, less risky portfolio. It's really important at SGI because it's the central focus of what we do. It's not a marketing pitch. It is what we do. It's what we're good at. It's what we live and breathe every single day. And so to an investor, the most important thing is that they get to their goal with the least amount of disruption. And by knowing every company we own and how they work together, then we can know how well the portfolio will perform. Step one at SGI is to spend literally hundreds of thousands of dollars to gather data from multiple providers and run that through our proprietary technology, which tells us how these companies relate to one another and what the least risky portfolio is combining companies. That's number one. How much risk do you need to take together today in the marketplace? Step number two at SGI is really to understand the return characteristics, the possibility for return within these companies. And there's a number of different factors that predict return. Different factors for small cap than there is for large cap, different factors for domestic than there is for international investing. And at SGI, we spend a ton of time on analyzing these factors, doing research on factors that actually are predictive of stock returns. And we create an expected return for every stock in the market. Now, we have the risk now, we have the return, now we want the lowest risk with the highest return. And that's really step number three. We call that optimization. So you have the lower risk portfolio with the best possible return, given your data. At this point, turn off the computers from a quantitative perspective and turn them on from a fundamental perspective. And this is really where we analyze the companies and we look at them for all of the type of things where I mentioned downside risk.
So what are some of the bigger catalysts?
When you talk about catalyst, you're talking about stocks that lose money. So what's the precursor to a company that's going to go down? And what you really want to be careful of is when companies go down significantly. It's usually caused by things like misconduct happening at the C-level suite. It's usually lack of transparency from SEC investigations, from firing their auditors or their accountants. A lot of these things happen within companies because the company is trying to hide risk or they're not being transparent with investors. And all of these reasons can be something that causes the company to catch fire and explode. And that's what you want to avoid. We're looking for transparency. We're looking for honesty. We're looking for that dry powder that you've heard me say. When we find a problem, we're out. We don't buy the company, or if we own it, we sell the company 100%. At this point, we've looked at the portfolio from a quantitative perspective of risk, from a quantitative perspective of return, the optimization of all of those things, and lastly, we've stripped that all apart and looked at underneath those layers of onions and saying, is there any problems here? No problems, we're a go. Managing risk at SGI is so different because it is intertwined in everything we do, and it's at the core of everything we do.